Good afternoon, everyone, and welcome to this webinar on BlackRock Frontiers Investment Trust. BRFI invests in the smaller emerging markets and frontier markets and has delivered strong returns in recent years, well ahead of the mainstream emerging market indices. And that's helped it win a Kepler growth rating for 2025. Shortly, we'll be hearing from two of the Trust's managers, Sam Vecht and Emily Fletcher. I think Sam and Emily are happy to take questions as they go along. But as ever, if you could write your questions for the managers in the box, we'll pass them over to them as they come in. So with that, I'll hand over to the managers.
Good afternoon, everyone. I hope you are all having a fine day today, even as the rain comes down in various parts of the southeast where we are sitting. Excited to talk to you about the BlackRock Frontiers Investment Trust. A series of slides ahead, but as was pointed out earlier, please ask questions at any point and we will answer all questions to the best of our ability. So if we sort of just kick off with the slides, it's going to be a joint effort between myself and Emily. I'm going to start and then hand over to her. So if people look at slide 2, they should be able to see a map of the world, and the countries colored in an orange are just some of the countries that we invest in. As a reminder, there are about 190 members of the United Nations. There are about 20 or so classed by index provider MSCI as developed. So that will be the UK, the US, Germany, etc. We do not invest in those. There are about another 20 or so classed by MSCI as emerging countries such as Brazil, India, China. And of those, we do not invest in the biggest 7 emerging market countries. We do not invest in Brazil or Mexico, in India, in China, in Taiwan or Korea, in South Africa. For the very straightforward reason that lots of other people look at those. About 85 to 90% of all emerging market funds assets are in those 7 big countries. Our focus in this fund is exclusively at the smaller emerging markets, as was highlighted earlier, and at frontier markets. So that is the smaller countries in the emerging market indices, such as Indonesia or Thailand, areas that often don't get a lot of attention. We also focus at frontier markets, countries that are even more exciting than many in the emerging markets, whether that is Morocco or Kenya, or many others that are colored in on the map. And then we also look at investments at the many countries around the world that aren't even represented in any mainstream indices. Often a company may be headquartered or based in a country, but because that country doesn't have a stock market, it may be listed in New York or London or Singapore. So we focus on the areas that very few other people are looking at. And it would be true to say that over the last 10, 15 years since we started this trust, even fewer people are looking at these markets today, which means our ability to add value, to add alpha for clients has actually been increasing. On the next slide, you can see some of our travels during the last year. For us, it's really important to travel to the countries we invest in. Although we build our portfolios bottom up, there is a significant top-down overlay. So we will always insist in seeing companies before we invest. We meet the company's customers, suppliers, competitors. The competitors typically more honest about the first company than the companies themselves. But in addition to that, we spend a lot of time on the ground, going to the countries that we can today and hopefully in the future will invest in. And when we go there, we're not just seeing the companies, we're seeing journalists, politicians, diplomats, trade unionists, students, all different parts of society to give us a sense of what is going on in the country. And for us, it's really important to go to a very broad collection of countries because we are not tied into any one country. So if you look at these beautiful pictures in front of you, these 10 pictures are just some of the places we've been in the last year. some fairly straightforward ones like, Indonesia, as is obvious in the top left, to the slightly less obvious ones like Guyana, the world's fastest growing economy, to Qatar, to parts of emerging Europe, and various members of the team travel. We cannot stress enough the importance of travel and meeting people and understanding what's going on across the entire value chain. We don't always discover happy things. Sometimes we discover that we don't want to be investing in these countries, but it's really important that we do travel and spend a lot of time doing so. So I'm now going to hand over to Emily to cover the next few slides.
Thank you so much, Sam. And I'd love to reiterate what Sam said at the beginning, that we'd love to take questions, and we're really happy to answer everything, and we will really try and get through any questions that you do ask. So if there is anything that you would like to ask really about anything at all on Frontiers, then I'm really happy to take any questions, so please do ask them. If we move then on to slide 4, and I get over the next couple of slides, to talk about sort of some of the sort of key things that we're interested in around the Frontiers world at the moment, and sort of what we've been doing with the portfolio at the moment. So the first thing that you can see on this slide is actually that there's a lot of countries where we didn't have that much in recent years. So sort of 2023, you can see our weights in some of these countries came down a lot. That's after, if you go back all the way back to 2015, our weights in these countries had been quite high, really quite a lot, and total about 35% of the portfolio was in these countries. Now, these countries you can see listed in the top, we've given you 6 there. So Pakistan, Kenya, Bangladesh, Egypt, Sri Lanka, Nigeria. Actually, we've also recently added quite a bit of the portfolio into Turkey as well, be another country that would feature as we've recently added. These, as you sort of can hear, are all smaller countries, and they don't feature very much in sort of any indices. And these are countries where I would say post 2015, as we were taking money out of these countries, they've all gone into quite steep recessions. They've all had quite difficult economic periods, or perhaps challenged political periods. But we think we're starting to see a turnaround. So whether that's Bangladesh, where we had the removal or the resignation of the long-time leader, Sheikh Hasina, 6 months to a year ago, whether that's some of the turnaround we're seeing in terms of Pakistan finances recently, we believe we've seen quite a change in trajectory, or at least in what's happening on the ground, or that the valuations you can get in those stock markets are really starting to reflect reality and overly reflect reality. So yes, there are still risks. Yes, there are still risks both on the political side, risks both on the economic side, risks around the companies that are operating there. But when you're starting to see markets where stocks are trading on 2 to 3 times PE, markets where dividend yields have reached 14, 15% in some cases, it's the sort of time for us that makes us think perhaps we should be there. So over the last couple of years, we've spent quite a lot of time visiting all these countries, meeting contacts there, and we think it's quite interesting to be starting to put money back into these countries. You can see it's not. Yeah.
I'm going to interrupt you because we've got the first couple of questions, and that's just much more exciting than listening to you. First question, what was the worst decision in 2024? I was going to say the worst decision in 2025 was interrupting Emily mid-flow, but I would suggest our worst decision in 2024, we probably made a collection of bad decisions actually in general, although we made some good ones as well. I would say not having more exposure to Argentina would probably be the worst individual decision that we made during 2024. It's a country we've spent a lot of time in over the last decade. In fact, we traveled there in both Q4 23 and Q1 24 and came away with the conclusion that while we had some exposure at that stage to Argentina, we thought that Milei was on the right track, but reversing 100 years of decline, which is what Argentina had experienced, would be quite tricky, and the hoops he would have to jump through, and the political disquiet this would cause, and just the economic challenges to actually do what needs to be done in Argentina would be extensive. And so after these markets had gone up quite a bit, we took profits and exited our positions in Argentina. In retrospect, that was a wrong decision because the Argentinian market has continued to go up and go up and then go up a bit more. So it's not that we lost money, but we definitely could have made a lot more money by having by having just a little bit in Argentina and actually backing our belief at some stage that Milei was a clean break from the disastrous Peronist governments that had preceded him. So I think that would be the worst decision. The next question I can see here, what would you point to as evidence of improving corporate governance in frontier markets? I'm going to start that and then Emily can disagree. First thing to remember is that typically corporate governance, at least in all emerging and frontier markets, is generally inversely correlated with PE multiple, i.e. the higher the PE multiple, the worse the corporate governance, for the simple reason that if the PE multiple is high, it goes to the heads of the CEOs, and they just kind of don't need shareholders. So typically, and we've seen this cycle in many countries, the higher the PE multiple, the less they're willing to see even people like BlackRock, and the more likely they are to give contracts to their uncles, their brothers, their cousins. And so the first thing I would say is that in general, corporate governance is improving, but it's not in a straight line in these markets. And typically, the more excited the market is by countries, the worse the corporate governance is likely to be because the CEOs won't care. In general, as I said, things are improving. That comes in various forms. It means we are much more likely to get accounts out quickly. Companies are much more likely to answer our questions, to have an IR function. They're much more likely to be much more open about who they're giving contracts to and have better disclosure in their annual reports. They are much more likely to meet Western corporate governance norms, but that's not true for all of these places. Obviously, there's a reason why they're emerging in frontier markets and not developed. Emily, anything you'd like to add?
Yeah, I think it's just really important to point out here that we only invest in companies that do have fully audited accounts. Although these are perhaps more unusual markets to investors, at the same time, we still see the same accounting standards really applied globally. Everything that we invest in has fully audited accounts. That's P&L, cash flow statement, balance sheet, and typically the auditors are subsidiaries of the Big Four. So just to make sure we add that in there. I would just give the anecdote, I think, though, of a company that I saw yesterday in the office, whose final question to me was, when I said, is there anything else you want to tell us? They were like, well, yes, you haven't asked about the board. We're reconstituting the board. We want to have more independent directors. We want to make sure that we're fully transparent, and is there anything else you can ask us, you can suggest to us for how we should do this? So I think what the pressures that we have seen on corporate governance globally are in 100% taken on board in these countries in the same way they would be in a lot of the other markets where you're invested.
And the next question is, if I read it correctly, can you provide P multiple, price to book, and yield for the portfolio? Emily.
Yes, I can, Sam. And actually, we have it on a slide. So let me just try and work out which slide it's on, so that I can ask for us to go to that. So if we could go to slide 7. Then actually we can see this, I think, for our portfolio. So the PE multiple on the portfolio is 9 times, and the price to book multiple on the portfolio is 1.9 times. So you can see that PE multiple is at a discount to our index, and the price to book multiple at a slight premium to our index. But really much for muchness. And I think the much more interesting point really is on the previous slide. So I don't know if we can go back to page 6. So we would say in absolute terms that those PE multiples I've just referenced are look very attractive, and I think they are pretty cheap in an absolute sense. I think what's really interesting if you look on slide 6 is just the huge disparity that we've seen to developed markets. As I'm sure you're all aware, our markets have remained at quite similar valuation levels, I'd say, over the last 10 years, while a lot of the markets in the rest of the world have got more and more expensive, and hence the discount that our markets are trading at is sort of at the highest level. I think you can see from slide 6 that it has been in the time that we've operated this trust. So I think on an absolute sense, 9 times PE looks like a pretty cheap multiple to me, and on a relative sense, these markets are looking very cheap as well.
Yeah, and I think I just add in terms of the yield before we go back to where Emily was on slide 5, which we'll come back to in a second. I just think it's interesting in terms of the yield. As an investment trust, we have to pay out 85% of our income. Obviously, the board set the dividend yield, but anyone can see we've, I think, announced our dividend for the fund, which dividend for this year, and we have a slide upcoming in terms of how much our dividends increased since we started. I think the bottom line here, which is interesting, is earnings for our companies have grown by about 10 to 15% a year, and they continue to do that. Payout ratios are fairly flat, but these markets are so cheap that it shouldn't surprise people that the dividend yield for this fund, depending on which day you're looking at, is somewhere between 4.5% and 5%. So we're not an income fund, but because our markets are cheap, because our companies actually care about corporate governance and actually pay out quite a lot of their cash, aren't just spending it in needless capex, we yield somewhere between 4.5% and 5%. So I'm now going to hand back to Emily, who's going to continue the theme on page 5, and she's going to do a couple of slides before we take the next raft of questions.
Fantastic, thanks, Sam. Yeah, so just to flip back to slide 5, so the second kind of broad brush point that we wanted to talk about for frontier markets is given here in quite a specific example. So first of all, I'll talk about the point that we want to say, and really here I think it's that these smaller emerging and frontier markets we think will be a beneficiary of the ongoing separation between East and West that we're seeing globally. So I'm sure you've all read a lot about the tensions between the US and China. What's really interesting for a lot of our countries is that they are trying their best to sit in the middle ground between the two sides. So most of the countries will have received investment at some point from both the US and from China, and will really be trying to neither align themselves with East or West, but be in a position where they can continue to trade with both sides. Now, one of the areas in the world that we think's really managed to do that extremely well is the UAE, and I think more broadly the Middle East. So the UAE has been taking increased stature as a financial centre, particularly, and I think that started really around COVID, when actually it was one of the places in the world that remained open the whole way through COVID. And since then, I think we've really seen just solidified that trend of businesses having a presence in the Middle East, often choosing the UAE as the place where they're going to base that presence in the Middle East, but that Middle Eastern base taking increasing importance within their global businesses. And so what you can see here on this slide is it's the largest property company in the UAE, and you can see their pre-sales. So obviously real estate is a sector that can be hugely volatile and cyclical. So we are wary of that, but at the moment what the trends are showing to us is very strong growth in pre-sales, as you can see in this slide. So more and more companies and people wanting to relocate to the Middle East and wanting to have their businesses based in the Middle East and take up real estate in order to do that. It's also somewhere which is, I think, people are using as a place to store their wealth. So if you want to buy an investment property, and you come from a country where perhaps it's not as stable as we're used to in the West, I think the UAE, Dubai, increasingly being seen as a great place to do that. And so therefore, I think that that's also what we're seeing here. This is kind of the Switzerland, the new Switzerland of the middle ground, as perhaps we could say. So, and I think that you can see from this slide really benefiting from that. So the third point we were going to talk about, Sam, on the next couple of slides, I think we've covered really in terms of valuation. So maybe a good time to go back to you for some of the later slides.
Yeah, and in fact, it sort of touches on one of the next questions that we have. How has EPS growth for frontier markets compared to developed markets over the short and medium term? And the answer is it's been better than that of the totality of the developed world, even though we have a lower PE multiple. EPS growth obviously is not the same every year, but it's typically been about 10 to 15% across our markets. It's not the same in all markets, but that's kind of what we've seen, and that's actually roughly the same as the level of dividend growth that we've seen over the entire period. It's important to highlight we're thinking about dollar returns here, hard currency returns. We're not very focused on returns in Kwanza, Naira, Kwacha, or any other emerging or frontier market currency. We're focused on returns in dollars, because that's actually important. Obviously, these currencies devalue over time. Next question, a new question, which is good to see a different person asking questions. Stock selection and style. What are the key drivers for stock selection, value versus growth, yield, etc.? Emily.
Oh, that's an interesting question, Sam. Yeah, thank you. That's a really good question. I think one of the things that's always really interesting about this portfolio is that it tends to not really have any style. And perhaps from looking at your screens, you can tell that neither Sam and I really have any style. Certainly, that's what our children tell us frequently anyway. In this portfolio, we tend to not really have a dominant style. And I think that's because when you look at our countries, they're all really quite different from each other. And what's going on in each of them is quite different in all the different countries and doesn't really affect the different countries. So if you take an example of Chile in Latin America, it's gone through a political cycle where it's moved a bit further left over the last few years. And I can tell you a little bit about what's going on. It's a big copper exporter in terms of its economic trends. But actually what's happening in Chile really has almost zero impact on what's happening in Saudi. You know, a country actually which has gone through huge social change, which is talking a lot about increased Saudization and employment of the local population, increased education levels. And what's going on in Saudi actually has almost zero impact on what's happening in Vietnam, for example, where actually they might be talking about consumer electronics exports. They're talking about sort of divide between north and south of the country, how you bring that together. What's happening politically, you know, and lots of nuances there, you know, but again, you can see here really, really country focused. So because of that, it means that the country factor is just much, much more dominant in determining stock returns than some of the style factors such as value or growth. You know, we can have one country where value is doing really well and another country where growth is doing really well. So as a result of that, actually, there are sort of two things that are really important to us when we're putting together our portfolio. The first is really what countries should we be in? And there it's about understanding everything about all the countries that we could be in. So it's about understanding what's happening in the political cycle, doing all the meetings Sam talked about, what's happening in the economic cycle, what's happening in the FX market, what's happening in the debt market, and really forming a view of whether we want to be in that country or not. And then the second half obviously is the stock selection piece. And that is stock selection piece we would do in the same way as really any other fund that you're invested in. So it's about meeting the companies, the suppliers, the competitors. It's about doing your DCF or your spreadsheet or your valuation technique and how you want to do it. It's about really trying to find a way where you have a view on the company and the stock that is different to the market. So I need to be able to articulate that I think company X should be worth 50% more because of Y. And that can be because it's going to grow faster, because it's currently undervalued, because it's going to win a contract. And I think it is because I spoke to company Y and I've got this great mosaic theory, or anything. You know, I just think that actually people have forgotten about it and it's going to carry on paying the world's most boring company, but it's got a dividend yield of 15%, and that's great. Whatever, but I've got a view that is completely different to what the market thinks, and if I am right, this stock is going to do really well. So it's those are the two things I think we look at. Is it a country where I want to be and why, and is it a company I want to be in and why? And when you can put the two together, easier said than done, but that makes you a winner.
I'm going to go on a couple of slides. So if we now look at page 8, page 8 just gives us a history of our performance. It's really important to highlight that we don't look at performance on a 3, 6 month, even a 1 year basis. It's absolutely critical that all investors, just like we do, look over the medium term. That said, we did do quite well on an absolute and a relative basis in both 24 and 23. And actually the last few years have been good for us. And you can see on this slide, since inception, our fund has returned 185% against, which is roughly almost exactly double the reference benchmark. That's not deliberate. That's exactly double, but it just happens to be something that I hadn't previously noticed. Exactly double the benchmark since we kicked off about 14 years ago. But it's important to highlight one has to take a medium to long-term basis for investments in these markets. So while it's very pleasing that we're doing well. It's not something that we look at on a daily basis. One has to take a medium-term view because of the vagaries of these markets. And then I want to go on one more slide before I take the next raft of questions onto page 9, because this goes back to a question someone asked earlier about dividend yield, and you can see how our dividends have risen pretty substantially through time. Our first year, we paid out 3. We are now paying out 9.5 cents. So we've pretty much tripled over the course of 14 years. And I think that's really testament to the underlying growth of the companies that we invest in. The next question which we have is the following. Geopolitical risk and Trump 2.0, an impact on country selection. What are the key geopolitical risks for the trust? What are your views on the likely crystallization of these risks? E.g., the Middle East has delivered significant gains over recent periods. However, there continue to be significant challenges in these markets, e.g., China outsourcing to countries that relabel goods. Okay, let me kick off with that one. And to make a general point about geopolitical risks, the markets we invest in are not Scandinavia. There will always be political risks in these markets. That is a critical part of what we look at. And it's just worthwhile highlighting what we always say. If there's something wrong with the politics, macroeconomics, fixed income or currency, forget the equity in these markets. Equity is a very small sliver of hope between two big numbers called assets and liabilities. And that sliver of hope can be destroyed very easily if politicians do silly things. And politicians do silly things in these markets. The most dangerous time to invest in any of these markets is when people are complacent about the political outlook. And therefore, it's kind of strange to say this, but places which people perceive as risky, sometimes it's actually not as risky as people think, because that risk is priced. The key question for us at any point is how much is that risk is actually priced into these markets. If people are complacent, if my mum says, oh, that seems a sensible place for you to be investing in, that's probably a very dangerous time for me to be investing in those markets, as intelligent as my mother is. So that's a general point. In terms of Trump 2.0, clearly his focus has been on China, not the country we invest in, on Mexico, not the country we invest in, and on Canada, not the country we invest in. Obviously, there will be tariffs more broadly on other countries, but we think, if we had to think about it sort of top down, we think the direction of US policy will be to encourage production in the US, but also in places that aren't China and possibly aren't Mexico, which should aid some of the countries that we invest in Southeast Asia, in parts of emerging Europe and elsewhere. We do not think it will be plain sailing, but we do think there's been an enormous focus on Trump and what he means, and really a big focus on all the negatives of Trump without thinking that there may actually be some positives. Lots of people in this country don't like him, so be it, we didn't vote for him, and he doesn't work for us, an important point to remember. But it does seem like there may be progress towards the end of the war between Russia and Ukraine, perhaps progress towards ending some of the fighting in the Middle East, and that would actually be quite good news for many of our companies that operate in the Middle East, operate in emerging Europe. So for us, when we look at parts of the Middle East where stocks are trading extremely cheaply, look at parts of emerging Europe where stocks are trading extremely cheaply, and everyone's going, there's a risk and there's a war, there's a threat of war. We think indeed those are true, but we think a lot of bad news is in the price. And we should remember that there are black swans, as it were, but there are also white swans. And that's important to remember. Anything else, Emily, you'd like to add on geopolitics and Trump 2.0?
I think that's a fantastic summary, Sam, on Trump 2.0.
Oh, thank you. I feel better. Next question. Do you have a model that drives this selection, growth rates, cash flow generation, etc.?
That is a good question, Sam. I think the best thing to say here is that we don't have a model, we do have a process. So it is something I think that we do in a fashion that is repeatable. But no, we don't have a model. We're really blessed to sit on a really big team as part of BlackRock, and we're able to call on colleagues and have dialogue with colleagues in fixed income department, currency department, trading department, legal department, who sit globally, and that I think is a huge advantage for me and Sam or Sam and I, apologies, that we can sit within BlackRock rather than running our own firm. So I think that would be the first thing to say. The second thing to say is we do have a process, so when we are looking at the macro of a country, we will always look at the external accounts, the liquidity, the activity. So we have a set way of going through, and we will review our charts and our macro process, all these countries every month or so, to make sure that what is happening is as we expect. And then on the terms of the stock selection, we have a hugely rigorous process, which I'm not going to go through now because it will not be as more interesting as everything else we can discuss. But I think the key message is that we have a really big team. We do really detailed due diligence. We spend a lot of time on the ground. We also spend a lot of time modeling, doing financial due diligence, going through accounts, building spreadsheets, having discussions, and sort of trying to refine the process to get the best stocks in the portfolio.
Next question, and I'm conscious we only have 14 minutes left, so get your questions in, and if there are questions we haven't answered, that may just be I'm not reading them right. Have each of you got skin in the game in terms of the share price? So this is actually a fairly straightforward one. Despite having been at BlackRock and its predecessor firms for the last 25 years, I have really undiversified investments. I own the house, which I'm currently sitting in. You could even see my beautiful Amazon exercise bike over my shoulder over there. I have some cash, and I have no investments at all that aren't the funds that I run. So I run a series of funds here at BlackRock. All my investments, all my money is in those. I own not a single share that isn't either in BlackRock shares, obviously I'm employed there, and I own not a single fund that isn't my own fund. So I couldn't have more skin in the game than I currently do, because I have completely undiversified investments, purely exposed to the company I work for and the funds that I actually manage. Emily?
Yeah, thanks, Sam. It's good to see that you're so dynamic with your investments and your exercise bike. Similarly to Sam, yes, substantial skin in the game. This is what we do. This is what we love. It's very similar to Sam. The investments that I have, other than my house that I'm sitting in, are in BlackRock funds that I run.
Next question. A new person asking a question here, if I'm right. When making an investment, are there limits in terms of the percentage of fund, the percentage of company being invested into? That's a really important question. Very straightforwardly, and it goes back to something which we alluded to earlier. We are not a single country fund. If we don't like what's going in the country, we will leave the country. We will have nothing there. We don't have to be perma bulls on country X or permanent bears on country Y, and lots changes over time. And related to this is the fact we don't want to be stuck in any company. We are not here to be controlling shareholders or be stuck in our assets. So every single company we invest in, we can get out of. Every single investment can be valued on a Bloomberg in 10 seconds. Everything is liquid trades, typically $1 to $10 million a day. And given the size of our fund, we can get out of these funds. So we don't like to have typically any more than 5% of the fund invested in any one stock. And you can see in our top 10s that we put out every month, typically there are a few positions at over 3 or 4%, very rarely anything over 5%. And the way you should think about this fund is typically somewhere around 50-ish stocks, all roughly 2-ish% of the fund. That's really the way. I mean, that's not precise, but that should give you some thinking about this. And we just don't like taking very big stakes in companies because we want to be able to get out. I don't off the top of my head know what the biggest stake we have in any one stock is the other way, but I doubt very much it's more than 2% or something like that in any, not even that probably in any single company. We want to be able to vote with our feet. We know that management, although sometimes other people fall in love with management, we do not. We know they make mistakes. We know we make mistakes, and we want to be able to get out at various points. Next question. You use gearing. What factors might cause you to increase or decrease that gearing? Emily.
Thanks, yeah, for the question. It does move up and down a little bit, often just as we find opportunities. So we are positive on the long-term future for these markets, and we've been pretty positive over the last few years. So I think you've seen the gearing come up, and it's been somewhere between 105 and 115% net long over the past 2 to 3 years. 3 years, I think now. I think the deviations that you see from a monthly basis generally are around just us finding the right times to trade in and out of stocks, more than us signaling on monthly basis at all I mean, a more positive or less positive view. So the messaging we would like to give is that the gearing has been above 100% over the last few years, because we think there's a lot of opportunities that are really attractive that we can find in these markets. And so we've been taking advantage of the gearing to do them.
If we move on, because I'm conscious we only have about 10 minutes left, let's go on a couple of slides. The next slide, which is slide 10, has our current country positioning. Don't say that quickly. And you can see our positioning across really a range of countries that many people may not have been to, and far fewer have investments in. On the left-hand side, you can see the absolute weights. On the right-hand side, you can see the relative weights. And I think the point here is really critical, is that just very few funds, if any, have meaningful exposure to these countries. These are really exciting countries where lots is changing, countries we're really excited about. But if you looked at the totality of emerging market funds out there, I would suggest the average emerging market fund has next to no exposure to Kazakhstan or to Pakistan or to Kenya or to many of these countries. So we really are focusing on areas that very, very few people are looking at. And if we go on to slide 11, we can see the sectoral breakdown across the countries that we invest in. There's actually far less to be said here. People look at sectors, it's actually far less relevant for the markets we invest in, because a Kazakh bank, a Chilean bank, and an Indonesian bank have absolutely nothing in common. So there isn't really a sector called financials. There may be companies that are all financial, but they don't really have anything at all in common. The next slide goes on to talk about our top 10. There is no typical stock that we invest in. When you have a typical type of stock, that just creates an enormous amount of style risk. But on here, we have everything from FPT, which is the Vietnamese IT company, to LPP, which is a Polish consumer goods company involved in clothing across emerging Europe, to Kaspi, which is a fintech in Kazakhstan, to EPAM, which is an IT company operating pretty globally, but with a base in emerging Europe. So really completely different companies that don't really correlate well at all together. And that's important. We're seeing opportunities in so many places. Emily, you like to pick up the thread on the last two slides?
Sure, thanks, Sam. So on slide 13, you can see the changes in the portfolio over the past year. And this, I think, would also speak to just answer a little bit around, what are the things we like at the moment, which is a question that we sometimes get. You can see that the portfolio has added a certain amount of weight into some of these smaller countries, as we've been saying. So if you see on the left-hand side, Pakistan, you see Kenya, you see Bangladesh. Those are all countries where we think that the global environment is going to be such that these companies can start to do well. As rates continue to come down globally, liquidity a little bit more benign globally, it's going to be about what they are doing in terms of economic improvements. And actually the IMF, I think, has been active in all of those recently and really trying to put the right financial policies in place. So we think that bodes well for those countries. That would be one. Second one, we've moved money into Turkey. That's a country where it's had really runaway in hyperinflation, and we think that they're in a position where they're starting to get a check and some controls on that inflation. So it's come down to around 45% at the moment, and we think through 2025 that inflation number should head down further, and that as it does, that should be quite positive for asset prices, particularly in the financial sector where we're positioned in Turkey. And then in terms of where we've taken money out, you can see right at the bottom we've substantially reduced our holdings in Thailand. So that's a country at the moment that I think is really challenged for growth. It's got quite an aging population, and it's a market where historically it traded at quite a substantial premium to a lot of the other countries where we've been invested. And I think as growth is being challenged there, or their growth outlook is being challenged, then people are rethinking what's a fair multiple for some of those stocks. So we've seen quite a substantial de-rating over the last 6 months in Thailand. And then on the next slide, so that would be on slide 14, Is that right, Sam? Am I on slide 13? 14, I think I am. Cool. Thanks for nodding. So on slide 14, just to bring a little bit together then about how we think about sort of the really key features then of this investment trust, and particularly, why we like the investment trust structure. So on the one hand, we think we've got growth. We think that being in these smaller countries, you have markets that are growing faster, and particularly with the growth challenges we're seeing in UK and Europe, these are countries that can really still growing. Eastern Europe is still benefiting from outsourcing. Asia, the Southeast Asian region is really taking manufacturing share globally, and the Middle East, I think, is a region that's continuing to develop fast economically and socially. So we have growth in these markets. At the same time, as you can see from our dividend yield, and that being something that's completely covered, this is because of the valuations and the cheap valuations that we're able to access. The yield is really attractive on this portfolio. So we're able to find a lot of stocks with interesting yield. That, as we said, is because of the cheap valuations. But one of the things we haven't touched on that may be slightly surprising is that we can do all of that, which sounds hopefully quite attractive, in a portfolio that has lower volatility than the FTSE. Going back to the fact that all these countries and what's going on in them is not dependent on the countries around them. They're very, very, very uncorrelated. And so they don't tend to move together. And therefore, in aggregate, the portfolio level, you end up with something which is really low volatility. It's very surprising when you first think about it, that you can have that. We think the investment trust wrappers are the best vehicle to do this sort of portfolio in. Why is that? It's because we have slightly less liquid stocks. They all trade about $1 million a day. You could value our portfolio with the Bloomberg terminal in about 10 seconds, but we do have less liquid stocks. And so being able to have the closed-end vehicle means that in our portfolio, we only own the stocks we want to own. We don't own stocks for liquidity reasons. We're just in the countries and the stocks that we want to be invested in. And that's a huge benefit for us of the investment trust vehicle. It's active management, as you can see from how we've moved between some of those smaller countries. We do have a 5-year life on the trust. We've been through 2 5-year lives already, and we have our 3rd 5-year life coming up in February 2026. And the board have said that at each 5-year life, they will offer any investors, that's big, small, whoever wants, the ability to exit at NAV less costs, in the format to be determined, obviously dependent on the number of investors. So that is coming up in 2026. And we have found over the last 14 years, I'm aging myself, but yeah, 14 years, that 5-year life has been a fantastic discount control mechanism for the trust, or a good discount control mechanism for the trust. And we've really seen that pull to maturity in each of those 5-year lives. So that would be our expectation again over the next year. So it's about growth, it's about yield, it's about low volatility in a vehicle that we think is ideally set up to invest in these markets, and where we are really focused on generating returns in dollars, not in any local currency, but truly in dollars, proper hard currency returns. And we think that it's got the features set up around the trust to really manage the discount and liquidity of these markets. So we believe it's such a fun place to work and a really, really interesting vehicle for looking at some of these smaller countries.
So yeah, I have to really totally agree with what Emily just said. That 5-year life coming up in just over a year, just under a year. So all investors can get out with one or all of their shares at that price, and that should limit the discount. 3 final questions. What are your views on the likelihood of the creation of a currency bloc to rival the US? Not very likely in the near term, not a big consideration for us. Do you ever hedge currency? No, we don't. If we don't want to be in a place, we're just not there. We don't make money for brokers. Is your Ukraine in your universe? Yes, it is. It's a place we've been to, and it's a place we look forward to investing in the future. We are running out of time. We thank you very much for your time. We are excited by this universe that no one else is looking at, where we can add value, where there's a lot of growth, and as Emily said, a lot of yield and fairly limited volatility. And with that, I hand it back to our friends at Kepler.
Thanks very much, Sam, and thanks, Emily. Number of comments coming in saying great presentation. And it was. Thank you also to everyone who attended all the webinars this week. Most of the presentation should already be up on our website, and hopefully the BlackRock Frontiers one will follow, subject to compliance approval. So with that, I will just wish you all a great weekend and see you on the next one. Bye, everyone.